point and they want to go through the review. Okay, let me share the screen. One last comment, I guess, before the exam, or there has been a couple questions about the final exam. It is a requirement. There is some answers, like a short answer, essay. They're not too long, but there is some multiple choice as well. So it's going to be very similar to the last one. And I haven't decided. I'll see how everybody does, but I might drop the lowest score of all your tests, but I do want everybody to take it. So we'll see where everybody ends up, and as I'm evaluating grades. All right, let me share my screen to do a quick review since we haven't really talked about either of these chapters. Both these are pretty simple chapters, and they don't necessarily appear like any other insurance type things we've talked about in the past, but can everybody see my screen?
Yeah.
Okay. So chapter 10 was about coming up with alternative ways to transfer risk using the capital markets. Because the insurance markets can be unpredictable, and that is exactly what I'm seeing right now. We are hitting some major challenges in the insurance market. It's very hard, it's hardening very quickly. Some of that's COVID related, some of that's unrelated to COVID, but we're seeing prices in all insurance markets rise substantially. In fact, I am predicting it's probably going to be higher than after 9/11, which was the highest in any recent memory. So over the next few years, we're going to see that significant increase. So as a result of having increased insurance prices, sometimes you have to look for alternative ways to pay for risk. There are 3 capital products out there that are talked about in chapter 10. The first being, I'm not getting this to scroll. The first being insurance linked securities. We call that ILSs, is another short name for that. The value of an ILS is driven by the insurance and reinsurer loss events. So it's based on the cash flows that arise from a transfer of insurable risk. So you're transferring it, and how that actually works isn't really spelled out in the chapter, and I've not had to use these before. But investors that have money that they want to invest in the market, maybe their stocks are doing poorly like they are right now, and they want to look for something that's going to get them a better return. So they might choose to invest in an insurance-linked security. The value of that security is going to be linked to insurable loss events. There's very, very low correlation between a loss event like a hurricane or a tornado and the effectiveness of the stock market. So for some people, it's better because that diversifies their portfolio. The second major product is insurance derivatives, whose value is also based on losses that occur in a specific period of time. So it might be a calendar year, most likely, or it could be even a longer period. And the value of that derivative increases as losses increase. So whoever buys the derivative is actually going to use that gain to offset the insurable losses. And the last option out there is a contingent capital arrangement. Essentially, this is a way to look for a way, in advance of a loss, who's going to help me pay for a loss. So it could be the best way I could put it is an equity line of credit. Maybe you say, if I have a loss, you're going to let me capitalize that using some kind of collateral, like my business. Or you could also offer that if I need the money, you get an equity stake in my business. So those are the 3 options. So a little bit more why these markets have come along. So a lot of non-insurance financial markets like banks were wanting to expand their business lines. And this gives them a way to actually take apart or get part of the profits that are out there to be gained by insurable losses. So they can actually, they don't have to be an insurer, they can actually get involved. The problem with all of these type of arrangements is they do take a great deal of time and expense to implement. So a little bit more about ILSs. They do help supplement that risk capacity. So when we can't get the coverage we need in the insurance market, we can turn to ILSs. And the cash, this is, you guys remember in the last chapter, last exam, we talked about securitizations, where maybe you have accounts receivable or mortgage receivable that you sell off for cash. This is similar in that you use an SPV, a middle entity, but instead of getting the cash up front, you're actually paying the SPV to hold money. So instead of paying an insurance premium, you're giving cash to the SPV in exchange that they promise to pay you if a loss occurs. So it's just like if you transferred money to an insurance company, you're transferring it to an SPV instead. And then when you actually have a loss, the SPV is going to go ahead and pay you cash for any losses up to your limit. If for some reason you don't have a loss during that period of time, then the ILS will take the money. Anyway, the cash they get, they sell the ILS to the investors. So they actually get capital infusion from the capital markets. You're giving them cash, the capital market's giving them cash. They have all this cash there, and they're actually collateralizing the loan. They have to set it aside. They don't do anything with it. It just sits in an investment account. And then when you actually have a loss, they pay you, and they might pay some money back to the investors. If the loss doesn't happen, then they're going to have to pay all that money, that both principal and interest, back to the people who invested the capital. So, and they usually have arrangements where if you have a really bad catastrophe year, the people that took the risk by putting money in the market would actually lose some of that. An SPV actually takes insurable risk because you're paying them money with the promise that they're going to pay you if you have a loss, and they're turning that into an investment risk, meaning they're turning it over to a capital investor who's willing to invest money in it. So they're actually, creating a new market of investments. Like I said, it's fully collateralized because they're getting cash from both the person who's investing money from the capital market and those organizations that are transferring their insurable risk. Catastrophe bonds. This is one form of an ILS. So the majority of ILSs are typically catastrophe bonds, which means they're tied to some catastrophe event. Maybe it's hurricane related or wildfire. And so they structure the ILS in a catastrophe bond. These are very similar to a traditional excess and reinsurance type structure. And losses that are that trigger payment under a catastrophe bond are usually based to over a period of time. What's the total loss? Let's say it's hurricane season. If this year's hurricane season exceeds a certain level, then those catastrophe bonds will be triggered. Most of these bonds are structured to only pay for very, very infrequent events like the 1 in 100 year event or 1 in 200 year event. So what's the benefit to the investors? One, they have that low correlation between the monies that they're investing here versus the monies they're investing in the stock market, which they love because it gives them diversification. The ILS also gets acceptance from the investors because, one, it's fully collateralized, and the rating agencies like Standard & Poor's will actually report on the credit worthiness of the ILS. So it's a pretty safe investment for them. There are some advantages for that type of ILS. First is it does give more risk transfer capacity. So if you can't get money in the insurance market, you can go to the ILS market. It's definitely a lower credit risk because you have those backings and it's fully collateralized. So you don't have to worry about, will I get paid? Like, let's say the insurance company goes bankrupt, you have that credit risk. Here, it's not a credit risk because it's fully collateralized. All monies are sitting in a fund somewhere. The disadvantages are there's some exposure to the market demand. So depending on if the market is soft, which it's now in a hardening, if it's in a soft market, investors may not want to invest as much, so they won't have a lot of they don't want to put their monies into this investment. What could I do with those monies? Instead of having all this money sitting in an account, there's that opportunity cost of assets that could have been used elsewhere. And then there's transaction costs associated with it. This is a pretty expensive option for people to use. There is a term called basis risk that I want you guys to know. Basis risk exists in every scenario related to risk, meaning that I have more losses than I don't have enough insurance or enough collateral or enough method to pay for my losses. My losses are actually bigger then I can offset them with. So, let's say I buy a limit of $500,000 on my insurance policy, but my losses are a million or 2 million. That's called basis risk. I don't have enough insurance to offset those losses. That also exists here in the ILS. Moving on to the insurance derivatives, the value of the insurance derivative, as the losses increase, the value of the insurance derivatives also go up, and that way the gain from that is used to offset any losses. Some insurers can spread their risk across a swap arrangement, which basically is between two insurers producing kind of a reinsurance arrangement. So what are the advantages? We've done insurance options and swaps before in the last chapter. What are the advantages? Well, you do get more risk capacity. So if you can't go to the insurance market, this might be an option. It is lower in cost than an ILS. ILS is, like I said, are fully collateralized and you have a lot of people involved. Those cost more. The other really good thing about this derivative is that it's got a very open, high volume market. So it's tradable. You can actually go out there and invest in a derivative very easily. And you know what the value is because it's like a stock price. You know what the value is based on the pricing at that point, that day and time. It's easy for investors to get out. So it's just like, you buy a stock one day and you don't like it and you decide to trade it, you can get out. In the ILS world, you can't easily get out because it's for a period of time. With the derivative, you can get out, investors can get in and out very easily. And it's very standardized and it's a lot more efficient for claims and contract settlement. The disadvantages is that there's still underdeveloped markets there. It's not as widespread as we would like it to be. There still is basis risk, which means what if I don't have enough to cover my overall losses, which exists anyway. There is some credit risk because it's not fully collateralized. So if the investor does not, come through and pay all of it out, then you have that potential. It's probably low credit risk, but it is there. And because these are unique and new, there is a lot of negative publicity surrounding these and how they are treated by regulatory agencies. I'm going to jump into contingent capital arrangements. So there's three different types. There's standby credit facility, a contingent surplus note, and then the catastrophe equity put option. The standby credit, this is where you actually get a bank or some other financial institution to agree in advance to give you a loan before you have a loss. So you agree up front, if I have a loss and I need to borrow money, I know what interest rate I can get, I know how much money I can get, and it's prearranged. And that is, you pay a commitment fee for that, guaranteed. So they get some money just by holding the monies aside and leaving some reserve for you. It's not a transfer, remember, because with risk transfer, if you have a loss, they have to pay it. In this case, you actually have to pay this back. So if you actually have a loss and you borrow money from this bank, you're going to have to pay it back at some point. Contingent surplus note. This one is more equity based. So again, you sell it to an investor and they treat it as a policyholder. So it's more of an equities policyholder surplus rather than treat it as a liability. So a person who would buy this contingent surplus note is willing to invest money in your organization and they would get shares of your company. So the benefit is it does increase your assets by getting money, inflow of cash, but it doesn't increase your liability. It's just going to increase, they get a say in your, and they get a piece of your equity. Catastrophe equity put bonds gives you the right to sell stock or equity at a predetermined price in the event of a catastrophe. So again, you're saying I've got equity investors that are willing to buy a piece of my stock at a certain price if I have a major event. So what are the advantages? Well, one, it makes funds available. You can probably negotiate cheaper on the front end before you have a loss. After you have a loss, your financial, just like the COVID event, people don't know the financial stability of organizations are shattered after an event. So having that arrangement up front really lowers the premium that they're going to have to pay. And there's a lower initial cost by having these set up. And it allows you to get that capital infusion from someone else at a predetermined price. The disadvantages is that, again, it's a loan in some cases, and sometimes it is equity, depending on the one of those three, but it could dilute your ownership if you have to, give someone else equity in your company. So when we're comparing the three different options of which ones are better and worse, they have different comparisons. One is ILSs and exchange traded options have a really high level of financial security. One, because the ILSs are fully collateralized. The exchange traded options usually are pretty structured in the market and pretty solid. Traditional and non-traditional insurance are a little bit, it really depends on the balance sheet of that insurer. They could be an A-rated company or they could be a C-rated company. So you have to kind of look at that. ILSs have a very low level of basis risk compared to, structured options and traditional insurance have a low level of basis risk. And exchange traded options tend to have higher basis risk than the others out there. So if you are the investor supplying the capital, what concerns would you have? You would be concerned of moral hazard. What if the company that I'm dealing with has set up or created a loss on their own? Well, one thing they can do to counteract that would be to have some kind of objective trigger, which means that something that's a parameter that's in place that the organization itself cannot control. That way, they can't skew the outcome, and it's truly based on an independent event that they can't control. Some of the issues with an ILS and derivatives is whether it should be regulated like an insurance company or regulated like an insurance product. They do require a lot more scrutinization if it's an insurance entity. So the more that you have objective triggers, like a specific event occurred, rather than you just turning in, I need money, the less likely it's going to be regulated as insurance. That's all I have for chapter 10. Did you guys have any questions about any of those? Okay. Chapter 11, we're looking at how do we allocate costs of risk. Every organization has a cost of risk, whether you buy insurance and pay a premium, or you have a risk manager like myself. You have to pay my salary. You have to pay for claims. You have to pay for investigation. You're probably going to have to pay for some risk mitigation costs. All of those are costs to the organization. So how do you allocate those costs and make it fair and make it make sense? That's what this is. It does sound like an accounting chapter, but it isn't. It's things to think about if you're a risk manager that you would need to do to allocate that's fair. So when you allocate, whatever allocation method you come up, you want to promote risk control. So you want to make it where if a manager in an operating department sees a charge on their financials and their balance sheet or on their income statement, they want to be able to control that. If they don't have any control, they're going to ignore it. You want them to try to minimize losses. So you want to promote risk control. You also are trying to facilitate risk retention. So if you know more about your risks, those that are lower dollar, you want to retain those and you want to transfer the big stuff, but you're really trying to facilitate risk retention because you can better control it. For example, City Utilities decides to retain auto claims. We do track auto claims, like if our workers back up and hit somebody, we want to maintain those because if we retain those type of risks, we can actually push it back on the employees to be safer. So we try to facilitate that. It also helps us prioritize risk management expenditures. It can actually help with risk control being promoted. You're hopefully going to reduce costs and you want to distribute fairly. So there's two concepts of how you allocate costs. There's the risk bearing option or the risk sharing. With a risk bearing, those that create the loss would get charged that loss. So that direct correlation between the losses they incurred and it getting charged to them. It's so important to have that correlation, because if I charge, for example, the electric department for losses that the gas department created, they have no control over it. And we would try to charge any of those expenses that were related to electric, and those related to gas, to gas. An alternative would be, you know what, we're just going to share all the risks together. So I'm going to share electric and gas losses. Everyone's going to be involved in the burden, and they have to share it and allocate it proportionately. The most effective cost allocation method is one that balances those two types, because you don't want to have everything being, you pay everything that you're responsible for. You also want some of the other departments to understand that risk and have a baseline level of sharing, because some things you can't tie specifically to one area. So those are hard to do. Having accurate allocation and reporting of cost of risk. This is really important. Believe it or not everybody reports risk or losses, and you want them to focus on where can they reduce risk. So we used to not track preventable car accidents, but as soon as you start tracking that and reporting on one department had more accidents that could have been prevented than the other department, then you're more likely to pay attention to the costs associated with that. You don't want to make your allocation method too complex, because when you can't understand where the costs are coming from as a manager, you really don't understand the relationship and how you can better manage the cost. It's true of any expense that they have to manage. There's also an opportunity for internal and external manipulation of costs. So internally, I mentioned that a lot of our departments just fail to report claims. Nobody likes to air their dirty laundry, so they just don't report it. They just fix it, don't turn it in, because it's like having an auto accident. You'd rather not turn it in to the insurance company, because then they know that you've had accidents and they're going to track you from that point forward. And then sometimes they inaccurately present loss facts, so they might hide some of those expenses. That's an internal manipulation. Externally, sometimes costs are manipulated by owners or senior management because they want the financial outcome to look better than it is. So there is some manipulation potential there. So you want to design that to kind of eliminate that opportunity for manipulation, whatever processes you can put in place. Allocation systems can be fully or partially allocated across, they have 4 different categories of costs. The first one being your cost of accidents, that you aren't going to get anything back from insurance companies. These are your retained losses. That's the first expense. The second, I'm going to jump down. The next major expense is insurance premiums. I have to pay some insurance premiums, those that are over my deductible. My third type of cost would be risk control techniques. So for example, City Utilities has a safety department, and we spend money on fire suppression systems. Those are all risk control techniques, and they have a cost. And the fourth bucket of costs would be, what does it cost to administer your risk management? So I mentioned you have a budget for your risk management. It's probably going to include my salaries. It's going to include some time spent by your senior management. It's going to include your claims representatives that help you process different losses. So those are all the expenses that you're going to allocate. Let me see if there's anything else that I missed. You're going to want to allocate your retained losses, and you're also going to want to charge some kind of a minimum risk charge. Like I said, you always want to charge a minimum cost to every department, but try to correlate as much as you can to those that can control the losses. If you can figure out a way to allocate an insurance premium to a department, that's probably good, and you want to do that. So for example, with our property, we know the electric department has a certain dollar value of property. If we can say we're paying so much property insurance for these assets that are electric related, then I can charge those directly to the electric department. However, the main corporate office can't really be allocated to one department, because we do services for every other gas, electric, water department. So those premiums are a little harder to allocate, but if you can figure out and can show that correlation, you want to try to match that. So after you figure out, what costs you have to apply, how are you going to, what method of allocation are you going to use? There's two different ways, two different methods, prospective and retrospective. You guys remember early in the semester, we talked about retrospective, where you go back after the fact and see how well you did and then kind of shore it up. With prospective, it's just like insurance. You charge to each department, here's what your cost is for the period of time, this fiscal year. I'm going to allocate so much risk cost to you. However, that doesn't represent what you actually incurred. It could be more, it could be less. And you do not allocate it at any time to shore it up. It might impact future periods, but it won't hit that period. So it's a very stable budget, because you can just say, here's my amount that everybody's going to get charged. I can budget on that, and it's not going to change for this period of time. The disadvantage of that is it could be substantially different with the actual outcome. Another disadvantage of prospective is eventually what actually happened and the outcomes are going to take several accounting periods to get kind of stabilized and figured out. Retrospective, you can go back multiple times during the period and say, oh, costs are higher, so I'm going to go back and I'm going to allocate those costs to you in this period based on what actually happened. The advantage is it more accurately depicts what happened. The disadvantage is it's really hard to get those all and get consistent budgeting. It's hard to budget for those. You can also allocate, another way to think about cost allocation would be loss exposure versus loss experience. Do I want to allocate cost based on their exposure that they have, like dollar value or the amount of revenue they have, or do I want to allocate cost based on their past loss experience? Those are two different ways you could look at it. If you allocate, rely more on, if you have a lot of frequent claims, a lot of times you want to allocate those on experience rather than loss exposures. So I'm going to jump down to exposure basis. You guys have had this in other classes, but we're going to go over it really quickly. So if you're doing general liability policy, what would be a common basis or loss exposure? A lot of times people will allocate general liability costs it could be based on your annual budget, your revenue, your payroll, could be square footage. That's all different bases that you could use. Auto liability is very commonly allocated by number of vehicles or miles driven. Does that make sense? So if you have costs associated with auto, you're probably going to do it based on the number of cars that you have and the number of miles you drive. Workers' comp is almost always tied to payroll and or number of employees you have. So obviously the more payroll and number of people you have, the more increase you're going to have in workers' compensation injuries of your workforce. Property values or square footage is the most common way to allocate property expenses, because you can actually say, here's the value of this building, or here's the square footage of the building, and that's how I would allocate costs. Some other considerations that you want to think about. Oh, I'm sorry, I jumped ahead and skipped experience-based. So this is based on what you actually incurred. If you can figure out, like if you have higher loss experience, you might want to allocate it that way versus your exposure rate. I'm not going to cover much there. Key points, so what considerations you need to think about before you pick an allocation system. One, can your accounting system handle it? That's not all accounting systems can do all these special allocations. What is the tax advantage? B, what's your tax advantage for the organization? Would I get some advantage by doing it one way versus another? What's the minimum charge for risk that I want to give to every department? Those baseline things. What about really small things? You might want to say, instead of allocating small dollar amounts, you really want to say, what's the dollar threshold that you want to look at? You don't want to allocate everything, even if it's insignificant. Kind of materiality is important. Do you want to penalize or reward department managers for managing the risk? So if they do something and cause risk, do you want to penalize them, or do you want to reward them in some way by maintaining and keeping their costs down? You definitely want to include operational managers in however you do it, because if they don't understand what they're getting charged, they will not understand what they need to do to keep their costs down, and it really helps that cooperation. You want to have consistency in your allocation system, and you need to see, it says here, we talked about this in the previous chapter, if you have a risk management information system, that's going to help you gather costs and know where the charges are coming from. So if you have that system, it would be good. And if at some point your organizational structure changes, like we restructure the electric department, the gas department some other way, you probably want to change your cost allocation method to reflect any structure changes in your organization. Does anybody have any questions about chapter 11? No. Okay. Any final question? Oh, did somebody have something? Oh, okay. Any questions for me before we get off here on the exam or anything for the semester that you're unsure about? Your grades, anything?
Like if if I want to submit the grade of this class to the CPCU website, should I wait till the grades came out?
Yeah, you have to have the final grade and then you can turn it in. You'll have to have that final, and I don't know if it's an official transcript, it's probably an unofficial, but you still have to have that final grade for them to count it. So you'll probably have to wait. I highly encourage you though to get it done sooner rather than later, because this is a grandfathered class. They're not going to offer it anymore. So you want to get that credit in. Some people wait like a year. You don't want to do that. Try to do it this summer after you get your grades out. Maybe make a note to yourself to do that as soon as you can. Any other questions? Okay, let me take a quick roll. I'm going to close my screen to make sure I have everybody that was on the call. Hold on a second. I'm going to stop sharing my screen and go back to see who's all here. Haley, Morgan, Lane, Dylan. Anybody else there? Eric, Amy. Okay, anybody else that I didn't mention? I'm looking around. Okay, I really love working with you guys. Very, very good luck to you. Is anybody graduating? Dylan? He doesn't have his.
Yeah, I graduate.
Well, I mean, you're not officially walking across the stage, but are you guys gonna are you gonna actually walk later?
Yeah, I plan on coming back in October, hopefully.
In October. Anybody else graduating?
Me. I will graduate after this summer.
Yay! That's exciting. Well, you guys will be awesome. Feel free to reach out to me at any time if I can help you in any way, or you can't get the CPCU credit or whatever. Just reach out to me. I'd be happy to. You guys have my work email as well. So great working with you guys. Take care of yourselves. I'll talk to you later.
Okay.
Bye, guys.
Bye-bye.
Bye.